Great. So hi, I'm Matt Liston. I work as a strategist for Gnosis Prediction Market, and I previously founded Augur. So Gnosis is a decentralized prediction market built in Ethereum, and let's start by taking a look at what a prediction market actually is. So a prediction market allows anyone, anywhere, to buy and sell shares in the outcome of any event. An example of this is, will Hillary win the 2016 general election? There's a share for yes and a share for no. Each share has a payout of 1 if the corresponding outcome occurs, and the price of all the shares should sum to 1. So in this example, maybe it's 0.2 for a no share, and that also represents the market's probability estimate of that outcome actually occurring. So there was a really good example of this in Ethereum world recently. I don't know, show of hands, who knows about the DAO? Cool, made my life hell. So after the DAO hack, there were markets trading DAO versus Ether. And when the DAO was created, people put in funds and got shares. And the initial price was 0.01 Ether per DAO share. And the way it was set up was you could actually withdraw the money that you put in. So in theory, the base price of a DAO share should have been the base price that people put in during the crowd sale. So this is a little snapshot of Kraken, DAO versus Ether after the hack occurred. And at this point, the price was at 0.00785 for DAO versus Ether. And there was some other factors, but in general, this represented the crowd's opinion that there was a 78.5% chance of a hard fork, which would then return funds. We can see after the hard fork occurred, there was now no risk. People knew their funds would be returned. And the price was back to the expected value of the shares. So this is a good example of how a normal exchange market actually was a prediction market on the outcome of what would happen with the DAO shares. So why are we building on Ethereum? Well, there's a couple reasons. In the short term, it's less risk for the actual service provider. So for example, the Gnosis co-founders previously built Fairlay, which was a centralized Bitcoin prediction market. And using a centralized prediction market, you're also custodian of the funds. And as we've seen with the Bitfinex hack, funds get stolen and the company's held liable. So using a decentralized prediction market, the funds are actually held securely in smart contracts. We're not in control of them. And there's effectively no counterparty risk. The user doesn't have to trust us. They just have to trust the code. And for both parties, it's censorship resistant. So prediction markets, different locations have different rules for these. Certain markets may not be allowed. Certain people may be banned from using the market. And using a blockchain-based decentralized platform, this isn't the case. The long-term goal, which is really most important, is creating a permissionless platform for all. So you can think about it this way. Normally, when you interact with a peer-to-peer platform, Uber or Lyft, for example, they actually control all the data. And if they want to change the terms of the data, or how the data can be used, they can do so in the future. Using a blockchain platform, everyone can access the platform in the same way. And there's crypto-economic guarantees for the behavior of the platform at future points. So you know what you're getting into, and it makes it much more enticing for a variety of maybe even competitors to operate on the same liquidity pool. This, in result, leads to better odds, lower fees. So what's really interesting about prediction markets is what you can build on top of them. There's a couple main categories of these. The first is gambling or financial applications. The second is buying and selling information or forecasting. The third is insurance or hedging. The fourth is action incentives, sort of capitalizing on a feedback mechanism between the markets and the actual event outcome. And the fifth is governance or decision-making mechanism known as Futarchy. So first, let's take a look at financial applications. There's two really unique things you can do with prediction markets here. One is financial instruments on very, very specific metrics. So instead of buying and selling Apple shares, you can open a market saying, what will Apple's Q4 revenue be? And this is really good for a couple reasons. One, if you're a research firm, you can sell your information more directly, participate in these markets. And two, it could lead to more efficient markets. If this information is available continuously, then it can be aggregated using models, and hopefully the actual share price is more accurate. The other unique thing that prediction markets can do in this space are conditional markets. So maybe you have an estimate of how many iPhones Apple will sell, but you're not sure exactly what impact that'll have on the eventual share price. So in this case, you open a market saying, what will Apple's share price be if over 20 million iPhones are sold in Q4? So in addition to unique applications, you can do some existing applications a bit more efficiently. One is you can replicate really any existing instrument with lower fees. An example of this is binary options. And you can also create pegged assets, whether it's pegged to USD or some stock, or it's a stablecoin that's designed to not fluctuate. And you can offer these to new markets. So maybe it's Venezuela or Argentina, massive currency fluctuation, and there's really no access to saving accounts. So a big one is betting. In general, prediction markets allow you to bet on absolutely anything that can be clearly resolved. An example of this, as I mentioned earlier, is who will win the 2016 presidential election. You can do normal things like who will win the Super Bowl, or you can do crazy things like will the Higgs boson be discovered in 2016. Probably the researchers who created prediction markets' original intended purpose was for information aggregation. So for example, government wants some forecast on what the expected harvest is in a region, things like that. Very, very good at using markets to aggregate the information of the crowd and get probability estimates. One example of this, so we had some researchers come to us and say they were working on a project to estimate the probability that a given parcel in Flint, Michigan had lead pipes. So they wanted to create 50,000 markets on each parcel of land and have their machine learning algorithms, or really many people's machine learning algorithms, interact with these markets to get a better look at, what's the landscape in Flint. So one really out there use case for prediction markets is insurance or hedging. In this case, you use a combination of a prediction market and a smart contract. You have a prediction market for the risk event. So, a very basic example is flight insurance. You have a prediction market asking, will this flight be canceled or not? And you have an insuree who sends money to a smart contract, which then buys positions on the yes side. And those positions should essentially pay out the amount that the flight costs. So here you have sort of an automated insurance policy. And what's happening is the actuarial risk is, or the actuarial work is being crowdsourced, and the actual insurance paperwork is all being automated by smart contract. So action incentives. As I mentioned earlier, there's sort of a feedback loop between market pricing, market volume, and the actual event outcomes. So in this case, if there is a market saying there's a very, very high likelihood that this event's going to occur, it's very cheap for someone to buy the unlikely outcome and then take actions to make that outcome occur. So one cool example of this is software security markets. So maybe I'm Apple and I want to see if there's exploits in Safari. So I make a market saying, will there be a zero-day exploit discovered in Safari by some date in the future? And I come into that same market and I spend $100,000 in the no position. What this does is it makes it so that a security researcher can come, spend maybe $100 and have a $100,000 payout if they discover one of these exploits. So it's a market providing an incentive to do something. So one thing that we're working on a lot at Gnosis is something called Futarchy. Futarchy is market-based governance. It can be applied to nation state, corporation, foundation, DAO, and it's really, really unique from other forms of governance. So in the Futarchy case, say you have some policy decision that needs to be made. Maybe it's a government deciding, should we fund this infrastructure project? Well, what you do is you create two markets. One market asks, what will the GDP of this country be in a year if we fund this infrastructure project? One market asks, what will the GDP be if we do not fund it? There's a market trading period, maybe it's 3 months, and people are betting on the outcome if this decision is made or not made. So at the end of the 3-month period, one of the markets is going to have a higher estimate for what the GDP is going to be under that decision. The corresponding decision to the higher estimate is made. The government, either funds or does not fund the infrastructure project. And at the end of that 1-year period, the actual GDP is plugged into the market. And if you bet that the GDP was going to be that amount, then you win a bunch of money. If you were inaccurate, then you lose money. So it actually, the people making the governance decisions now have something at stake. So Futarchy was developed by a researcher named Robin Hanson, who's also sort of the godfather of prediction markets. And it's interesting in the context of DAOs, because DAOs are supposed to be automated. And using Futarchy, you can automate the entire governance process. You use the wisdom of the crowd to figure out what the best decision is. And then you have the smart contracts just plug into the market outcomes and automatically implement those decisions. So an interesting example of Futarchy is how it could have been used to prevent Brexit. So in this case, the decision that we're making is, should the UK leave the EU? The success metric is the pound. So you have two markets. One market is, what will the value of the pound be in 6 months if the UK leaves? And then another market asks, what will the value of the pound be if the UK does not leave in 6 months? So hopefully the traders would have been smart and realized that the value of the pound would tank, and they would have shown that in the markets and the decision wouldn't have been made. However, maybe the market was dumb and they thought it would go up. So if the estimate was higher for doing the Brexit, then that decision would have been implemented. And then 6 months later, we would have plugged in the fact that the pound tanked, and the people who bet in those markets saying that the pound would rise because of that decision would lose a ton of money. So Futarchy is very, very interesting. It also has some risks. One is finding the right indicators. So in the example of the Brexit, the pound is a really good indicator for the Brexit, but a lot of other things could have impacted that. So it's a little bit difficult to isolate exactly which metric you should use, and also which time period you should use to gauge that metric. There's also a problem of market manipulation. So say we're talking about a corporation, there may be incentives for some people to manipulate the market to implement a certain decision. One example is, maybe it's a market asking, if we fire the CEO, what will the share price be in 6 months? And the CEO doesn't want to get fired, so he buys into that market and manipulates the price. Another example with Brexit is, maybe you're a manufacturer in Britain and you sell to the British market, and you would benefit from high customs between the EU and UK. So these are problems. And we at Gnosis have received a dev grant from the Ethereum Foundation to research some of this. A very basic example is just to provide a monetary incentive for certain traders to manipulate the market. So in the base case of our experiments, this means we have a prediction market asking, what's the output of this smart contract going to be? And the smart contract verifiably will output 5. So people know, if the value of this market is not 5, they should push it to 5 because they have a guaranteed profit. However, these other traders know that they're going to make money if the average price in the market is above 5, a certain amount. So they'll lose money on the shares, but they'll make money on the manipulation. So in a way, this simulates what we were talking about with Futarchy and the issue with market manipulators. So let's take a look more specifically at what is provided by Gnosis. So at the core of Gnosis, you have markets, which are smart contracts on the Ethereum blockchain that essentially serve the purpose of pricing and trading shares and taking the opposite position in these trades. You also have off-chain trading using state channels, which is incredibly important for scaling. Prediction markets are huge applications, so if we get to the point where we have 100 transactions per second, this is not going to work on chain. It's not fast enough, there's high fees, etc. So off-chain trading allows the trades to happen off the chain and then to be settled on the chain at a later date. And this is done with very minimal fees and higher theoretical throughput than like Visa transaction networks. Now, we also have crowdfunding, and the crowdfunding is specifically for the initial subsidy for markets. So we use something called a market scoring rule, and the way a market scoring rule works is you put up an initial subsidy which creates liquidity for the early traders. For certain markets, this could be $100. For other markets, maybe it should be 100K. And that can be burdensome. So using Gnosis, you can crowdfund this initial subsidy that you need to provide. And finally, a really big part of Gnosis is our Oracle market. So an Oracle in the context of prediction markets is something that brings real-world data on-chain. So smart contracts are super smart, but they're not really good at getting anything outside of the chain. So in the example of Hillary, someone needs to come in and says, yes, she won, or no, she didn't win. So we have a marketplace where people can sign up and provide Oracle services. And it's not just to be used for the prediction market, but also for any DApp. Any sufficiently sophisticated decentralized application needs oracles of some form. So I went over this a little bit, but I'll recap. Anyone can create markets with our prediction market platform. They can either use the core platform, which we have developed and you can use now, or a custom app interface for trading. You can choose or write your own market mechanism. By default, it's something called a logarithmic market scoring rule, but you could also implement parimutuel markets, a different market scoring rule, an order book, etc. You provide initial subsidy, can be crowdfunded, and all of this can also be done using state channels for efficiency and scaling concerns. And our Oracle market. Anyone can offer their services. As I mentioned, it's a standalone platform, not just for the prediction market. It's very, very flexible. You could be just an average Joe independent Oracle who's Googling stuff and inputting the information. You could be an existing entity. You could be Bloomberg, Reuters, ESPN, Wolfram, which would provide very high security just by reputation, market cap, et cetera, things at risk. Or you could be something very specific. For the insurance use case, you essentially need a claims inspector. I mean, if you have car insurance, you need to verify that someone isn't just saying that their car was totaled or whatever. So a claims inspector could actually be an Oracle through our Oracle market. And there's benefits from our model. One is very rapid resolution. The Oracle data could even be a data stream. You could get high granularity and lots of variety, as I mentioned. So there's always a trade-off between centralization and decentralization in terms of efficiency. And we sort of allow several options on this gradient. So we have some security methods in place. One, every Oracle is going to have a reputation. Initially, this could be bootstrapped through like social media reputation, but as the platform grows, it should be internal reputation. Have they settled events correctly? Were there disputes, etc. The oracles can also be required to place security deposits. These security deposits could be lost in the case of a dispute. Any Oracle resolution can be challenged. So if someone comes along and says, no, Hillary lost, and that wasn't the case, then someone will challenge it. They could lose their security deposit, etc. Another very likely mechanism for many markets is redundant oracles. So if anyone's familiar with multisig, kind of the same idea. You need 3 oracles out of 5 oracles to sign in order for it to resolve. Each one places a security deposit. The ones that resolve in the incorrect direction could lose their security deposit. And finally, for all these mechanisms, you can challenge it and send it to a last resort decentralized ultimate oracle. I'll answer questions on this later if anyone has them, but the overview is it's sort of creating a prediction market on the outcome of the prediction market. So one thing that Gnosis is really focused on is being a prediction market platform. We think that because there's such a variety of prediction market applications, each one really requires a unique trading interface, marketing strategy, regulatory strategy, etc. And it's also very beneficial to us as a platform if many people are building independent applications on top of us. So our goal is to make it as easy as creating a Facebook page for someone to create their own prediction market application, and also to integrate a prediction market into a site like a widget. So get the question a lot, so quick comparison between us and other decentralized prediction markets. There's a few now that are being built. A few others use a decentralized oracle. We have a decentralized last resort oracle, but it's not by default the decentralized oracle. And we believe that using a decentralized oracle is unnecessarily costly. You don't need many, many people reporting on something that can easily be Googled. We also think that it's not very flexible. The existing decentralized oracle mechanisms don't really work for anything that is specialized. It has to be something that everyone can come to a consensus on through Google. So things like the claims inspector just can't be done. It's also slow. Say you have a market asking, will this team score in the next 10 minutes? And it takes a month to resolve. That's kind of a no-go. And finally, there's potentially large attack surfaces for these systems, both game theoretic and code. So as I talked about before, Gnosis instead uses an oracle market, and we think it's a more user-friendly and efficient solution for this problem. And also, we are very, very focused on being a prediction market platform. So the interesting part, we're having a crowd sale. It should start around DevCon 2. DevCon 2 is September 12th or September 19th, and we plan to start a week before, and it'll last for 4 weeks. What you're funding is the Gnosis DAO, which is tasked with building, running, and governing the platform, and also the Gnosis Fund, which is a vehicle which invests in projects being built on top of Gnosis. And we think having both of these is really important because the platform level really only gets a portion of the revenue sources. It gets fees in the platform level. However, the fund can invest in the applications on top of this, which is an additional revenue source. So a big question is how to do this securely. Obviously, the DAO changed a lot. The main thing is not breaking too many things at once and taking incremental steps toward full automation. So initially, funds are going to be sent to a secure multisig, and the multisig signers are going to proxy the DAO governance decisions. For those who don't know what multisig on, it requires several signers, well, a majority of signers, to sign a transaction rather than just one signer. So let's take a look at what might give our tokens value. In general, the platform tokens are gaining value based on fee revenue atop the platform. And we have some interesting mechanisms to do this. One, the platform tokens can be time locked, and they essentially get these other power tokens as interest. So maybe I take my platform tokens and I time lock them for 12 months, and every day I get a little bit of these power tokens. And the power tokens can be used to pay or subsidize trading fees in the market. So a good example of this is, say you are a Chinese sports betting application and you want to build on top of Gnosis, but you don't want your users to have to pay all the fees on the platform level. You want to charge users fees on the application level. So in this case, it would make a lot of sense to own a lot of the Gnosis tokens in order to get these power tokens to subsidize fees for your users. If the fees are not subsidized using these power tokens, they're taken in whatever token the market's denominated in. And what we're going to do is the fees taken are exchanged for our tokens, and then those tokens are burnt. So there's effectively a deflationary supply of tokens. So as I mentioned, our governance plans to use Futarchy mechanisms. But first, let's take a look at how tokens for founders are created. In previous crowd sales, there's a set pool created for the founders. Historically, this has been between 20 and 30% for similar crowdfunder or similar projects. In our project, it's a little bit different. The funders can actually decide how big the core pool is. So the way this works is, say you put in 1 Ether and you get 100 of our tokens. You're then given the option to create between 0 and 100 tokens for the core pool, essentially diluting yourself but not taking any tokens from yourself. So this will eventually result in somewhere between 0 and 50% going to the founding team. And also, these tokens are not going to be immediately accessible by us. They will be vesting over a 3-year period. So on to governance. We're sort of doing a hybrid between a centralized startup organization and a decentralized distributed autonomous organization, doing it for agility purposes. So the way it works is the core team makes proposals. Maybe it's paying salary, paying a contractor, etc. These proposals are accepted by default and funds are sent. However, anyone can open a veto period. So say the proposal is for spending $100,000. That person would deposit $10,000, which would be gotten back at the conclusion of this veto process. And what that does is it opens Futarchy markets. So you would have a market for what is the token value going to be if we fund this proposal? What is the token value going to be if we do not fund this proposal? And as I explained in Futarchy, the decision is made corresponding with the higher estimate. But again, this is only done as a veto process. So by default, things go smoothly. You can even fire the core team, which I wouldn't recommend. Okay, so that's the slides I have.
Thanks, Tom. So in your example with the lead pipes,
yep.
How does the information about the lead pipes actually flow into the market? Like, how do we know that can be accurate?
Right, so it would be a market, is there lead pipes, yes or no, in this parcel of land?
Doesn't someone at some point have to actually go and figure out there's lead under the ground?
Right, so the researchers that came to us had students who were preparing machine learning models using data points and then their algorithm, and then that would interact directly with the markets.
Okay, so you're trying to like analytically predict?
Analytically predict, and then the markets would be settled after the pipes are dug up.
In line with that same topic, what is the value of information aggregation in a situation like that described, where essentially you're going to have to do the work to resolve the market anyway, so why does it matter if you create a prediction market in the first place to try to guess at the information in order to resolve that? And to resolve the contracts line, you have to go do the work and find out the answer and obtain the information you're asking people to guess at.
Yeah, well, that's a good question. I'm a little stumped because I'm not the researcher and I didn't have this conceived. But you could optimize which parcels are dug up first, or potentially if there's an incredibly low estimate, then just prioritize the ones that have high estimates.
Actually, two separate questions. One is related to the point that you made about not having credit risk. So if one is placing a bet on the prediction markets, how exactly is the credit being taken out of the picture? So that's part number one question, question number one. The second question is more related to old contracts. If you want to put those old contracts into a marketplace or create smart contracts, rewriting the old contracts as smart contracts, is there any thought around those? Because that's where I believe most of the difficulties would lie. I mean, most contracts.
You mean like updating a contract to include new code? Yeah, so I'll start with the first question. So first of all, there's no credit in the markets. It's not fractional reserve whatsoever. So there's always enough funds in these smart contracts to cover all of the shares. Does that answer that portion?
So if I'm willing to bet $1,000 that Hillary is not going to make it, and then I lose, what exactly happens to me? I mean, those who made it,
they're going to get your money.
Huh?
They're going to get your money.
Right, but so is there a escrow account or something like that?
Oh, right. It's essentially escrowed in the smart contracts. Sorry, one more question for him. Other question was updating contracts, right? So interesting, because we currently took down our previous, we had a version of Gnosis running on the Ethereum mainnet with real money for about 6 months, and we took it down a few weeks ago because we're deploying a new version. So currently, the way it works is markets close, you take down the contracts, put up new contracts. However, in our new code, it's possible to update the contracts through a mechanism on chain. So you replace parts of the code using a rule set in the code.
So like for oracles such as like Wolfram or like let's say bigger companies, are you guys doing like a revenue share or something with them to incentivize them to like provide accurate data?
Yeah, good question. So just in the Oracle marketplace, any Oracle can set their fee for the data. So they would just set whatever fee they require to offer their services. Sorry, what?
I have one more question.
Go for it.
So on that topic of like politics, so if this is similar to betting, when like in sports, if you bet, it'll incentivize people to, for instance, rate games. So when in this sense, like it will at some point incentivize people to actually rate elections, because there's so much, let's say, money on the line that people don't care who wins as long as they won the most amount of money.
Yeah.
I would be incentivized to sell my votes and do a lot of stuff related to that. So would that technically be legal, or I don't know?
Oh, legal? I don't know. Possible, yeah. So I covered incentive markets a little bit. That's just taking it in a larger scale. So if you have sufficient volume, yeah, it could sway the outcome. I think for an election, it would need to be on the order of billions, but theoretically possible, yeah. Legal, I have no idea.
Yeah, because technically you don't need like everybody to be voted to win, so you actually maybe need like 10% of the population or even less to actually rate the event.
So in that case, if your payout from the market is greater than the cost of effectively bribing people to, implement your decision, then it's rational to do so. There's also not really an effective method of bribing people because votes are cast anonymously. So you need a smart contract that says, I will pay you X amount if you vote this way, and you must take a picture of your ballot and your passport or whatever, and then you get the payout. And it would need to be massive, massive amounts.
Going more from like a regulatory perspective, most of our kind of regulatory steps that you're taking, like we talk in CFTC, because, for example, sports betting is illegal in America. What happens when like Oracle start doing sports betting, or SEC with like futures and options?
Right. So first of all, our policy is to have open communication channels with any regulatory agency that wants to talk to us and to comply with everything possible. We can't exactly control what applications are built by third parties, but I can say from a strategy standpoint, from my end, I wouldn't touch the US market. It's very, very difficult to penetrate from a regulatory perspective.
Also, you said part of it was governed by a multi-sig. Was that the DAO fund that is being governed by multi-sig?
Right, that's the Crowdsale funding.
Right, so they could also potentially like regulate that somehow or like prevent you from investing in it.
Right, so the Crowdsale entity is not US, and we're doing it in an entity where we know it's legal to do this and it won't be considered a security. However, there's still complications in allowing US customers to participate in this, and there may be some steps taken with regards to that.
Since a lot of like forecasting events are long term, have you thought at all about how to let people participate without being exposed to like the volatility of the underlying currency? Because like you see so many scenarios where you make money in the market but lose money from the volatility.
Yeah, great question. As soon as there's a stable coin that's viable, we use it. For anyone who doesn't know what a stable coin is, it's either a token that's designed to be as stable as possible, or it's something that's pegged to another asset. So it could be a coin that's pegged to the US dollar. And we're confident that in the next 6 months to a year, we will have a viable option for that.
Is there anything that's like close right now that you're considering?
There's a few stablecoins on the market, but I'm not convinced that they're secure under edge cases, unless they're just ridiculously collateralized. But we have some projects that we're working on, or others adjacent to us are working on, that we think will be viable.
So what is exactly your goal and your aspiration as a company? I'm trying to figure out what you guys want to do, because there's a lot of problems with the US market. You know, we can use it in New York, or you can use it in some other state, and you know, obviously like betting is like very complicated, like to regulate. And so, what do you guys exactly want to do out of the decentralized platform? And also, like the other point that I think it's great. I mean, we all we kind of burn with the DAO, and like it's frustrating. But it's great that you're saying, oh, that people can actually fire our founders with Gnosis. It's great, but I think there's like a inherent bias in kind of like just not voting almost. So people like there's a very inactive and there's no much of voting participation. So how would you like keep people that buy tokens engaged and or even informed, so that actually their votes matter beyond like just.
Okay, just recalling your first question. Right. So first of all, we want to be a prediction market platform, just allow anyone to create a market for anything and make it as open as possible. And we want to be sort of a global liquidity pool for all these applications. Oracle platform, similar. We want to be the go-to place for anyone to offer their Oracle services to smart contracts or find an Oracle for their smart contract. On to your second question. So engagement's a media and PR problem. So we have a Slack. You can join at slack.gnosis.pm. We actively post on the Ethereum Reddit. We'll make press releases, be in media, accessible by email.
Right now, referring to if you look at BitShare, right, like that's kind of like the most available time to engagement for token holders. Right?
Yep.
So like, it just doesn't matter. Yeah, you can participate theoretically, but it wasn't the case, for example.
Right.
And I maybe you thought about some
Right.
way.
Well, another, like a comparison between us and BitShares and a lot of other projects is we should be a lot more engaging because people can actually use our application, not just create a fake token, but actually bet on whatever you want to.
So to the question of bet on whatever you want to, you mentioned that like tokens will create liquidity for positions. At some point, like so, if I want to make a, I want to place a bet on whether or not we'll go back to the moon in 2015. I need somebody on the a counter
Got it, yeah.
party person. Is that what you meant by this, or
Yeah.
are you kind of?
Yeah, absolutely.
So what tokens are then creating the liquidity for that position?
Oh, you fund it with probably whatever's trading in the market. So maybe you put up $1,000 worth of Ether, and that provides the counter position for early traders.
But okay, so say I create. Okay, so instead of creating, I create the market, but then I want to take a position. So, but I still don't have a counterparty for that. I need to find. There needs to be a counterparty in the network, for my position to even
So
now become real, right?
So you create the market, and then you provide this initial liquidity, and that also gives you a share in every outcome in the market, and it creates the shares. And then you probably also want to buy some additional shares because you probably have a sense of what the probability is going to be, and you'd lose a bunch of money if you just do the initial subsidy and then don't market make it all.
Okay. All right, that makes sense.
Two questions. First is, do you have concerns about getting liquidity into the various markets? That's the first question. And can you just give a general idea of some of the projects that you see up above?
Yeah, liquidity is the main problem with prediction markets. It's sort of a feedback effect where if there's more liquidity in the market, there's more accurate pricing and more incentive for people to come in. And a big part of that is focusing on being a platform and having all these unique interfaces and being a common liquidity pool. But it's a non-trivial problem, so it's something we'll continue to focus on. Sorry, I don't remember your second question.
Secondly, what do you plan to build above? Some of the projects you might build above.
Oh, sure. So one thing is we're working with a pretty big financial firm to do initially like a forecasting tool, but later sort of what I was talking about with the very specific financial instruments. So that's a big thing. The big two in terms of revenue application use are financial stuff and betting applications. So I also expect sports betting applications to be built rather quickly, probably ones that don't target the US market but actually have regulatory pathways.
And, sorry, I missed what you said about like the big Oracle, like decentralized, like I don't know, you said like the universal one or something?
Right. So that's sort of the last resort. If the centralized oracles or the multi-sig of oracles doesn't work, it just keeps being challenged, it goes to this. And it essentially opens a prediction market on what was the outcome of this event. So in the case of did Hillary win? Oracle said no, challenged because yes, she won. Now there's a market where it's people placing money on yes, she won, no, she didn't win. So in this case, there's an incentive to participate in the market honestly because there's an expectation that there's sort of a coordination game and people will go in the honest direction. And you could actually win money against the dishonest side. And there's like a slight complication in this market. So the event is only settled if for 2 consecutive 48-hour periods, the market is going in the same direction. So in this case, it could be the first 48-hour period, there's $5,000 on yes and $1,000 on no. Second 48-hour period, there's $10,000 on yes and $2,000 on no, and then it's settled because it's been yes for 2 48-hour periods. However, if it changes in a 48-hour period, then you keep going until you have those 2 consecutive periods.
So if it fails, like the first time somebody submits a response, then that person gets rejected or something?
Someone challenges it, it goes to this mechanism, and then additionally, if this last resort mechanism goes against what they said, they're going to lose a security deposit.
So for all these people that want to join on like decentralized protocols, they have to like join on beforehand. It's not like everybody who is on the platform can become an oracle.
So to sign up to be an oracle. Yeah, anyone don't even have to be like, using the prediction market. You can just sign in using OAuth or something and say, I want to be an oracle for this. And here's my fees, and here's the data types I can provide, and maybe some category tags.
So could you elaborate a bit more on the fees? Specifically, how much do you expect the platform fees to be? And then what are these fees going to be used for in a little bit more detail? So what are they going to be funding?
Got it. Okay. So fees for similar projects tend to be around 2%, but we want it to gradually go as low as possible to remain competitive. The fees are, you trade in the market, you pay 2% of your trading. Then those fees are essentially passed on to the owners of the token. And the way we do that is, say the fee's taken in Ether, and we get 10 Ether in fees. We then buy our own tokens using those 10 ethers, and the tokens that we buy are burnt. So now the supply of the token is actually lower, and it just keeps decreasing.
And so then what's the end state? Once all the tokens are gone, then?
I wouldn't expect the tokens to ever be completely depleted, but as you do this process where the supply is reduced and also some of the tokens are locked because of that security deposit, or not security deposit, the time lock deposit to get the power tokens, the value should increase steadily.
What are you doing to prepare for the eventuality that tokens will be stolen out of smart contracts that you provide for markets? And are you thinking about liability that Gnosis has as a company for providing these smart contracts for people to use?
Right, so I don't have a complete answer to that, but I can say that at ConsenSys generally we're working on like escape hatches for contracts. If they're not functioning as intended, then there's like a kill switch button to do it manually. More generally, our first version or second version that's going to go up next week, it's real money, but huge disclaimer, this is a test. And there's going to be a substantial security audit process for future releases.
From a technical perspective, can you kind of explain how the state channels work? Not like the state channel part itself, but like, are you running your own state channel network?
No, so we intend to use Raiden. Could you ask specifically?
Like, won't everybody on Ethereum be using Raiden?
Yeah, we might be one of the first, but yeah, it's important for scaling, absolutely.
If a market is being manipulated, are there going to be like forums so that can be discussed clearly out in the open, and then people will learn that all the information about that market exposed and also
So in general, if a market's being manipulated and it's not for the purpose of Futarchy where there's some ulterior incentive, the people manipulating it are, throwing away money. An example of this, I'm not sure if it was on InTrade or something else, was, I think it was Mitt Romney or John McCain's election campaign was buying millions of dollars of shares in a prediction market to make it look more likely that their candidate would win. But it wasn't that likely that he would win, so they lost their money. So in general, that's how market manipulation works. But I also expect, if the probability that's shown in the market is wonky, people are going to talk about it and they're probably going to buy shares and make money in the opposite direction.
But let's push an example to math. Let's say I have an event which is my car gets in an accident. And the players are a few insurance companies, 2, 3, 4, that are sort of bidding for this. Then you have to have a mechanism to prevent off-track because you have a limited number of players. If you have millions of cars on prediction markets, and this is sort of bought as an asset to replace insurance, then you sort of have to have a mechanism to prevent collusion because you only have a small number of players.
I follow.
Is there a mechanism to do that?
To prevent collusion in the case where there's a small number of players. I don't have an immediate answer to that, but it's a really good question, so thanks.
Couldn't anybody just sell that market though?
That's right.
Yeah, anybody can just sell the market.
Yeah.
It's not like, the only thing that's limited is the oracles, right? So like, it's like the price for insurance on cars is super high, then a bunch of random people can just sell it. Like me or you can just sell it.
Yep, similar to the market manipulation case.
Is there a way to shut down unethical markets, like forecast on the death of somebody? Is there a governance for that? I mean, like implicit in Gnosis. I mean, is there a way to?
So that's a really good open question. We may consider having a mechanism for the crowd to decide which markets to censor within Gnosis. More generally, it relates to the DAO hard fork problem, where if there's a market of that type, maybe the miners collude to not include the transactions. But yeah, there needs to be probably better solutions.
Do you worry that your token sales create registered securities?
No.
there a certain amount of tokens that you're making, and also is there a maximum crowdfunding?
So there's no cap, and did you ask if there's a target?
How many tokens can be made, or is there?
Oh, right. So for the platform tokens, there's only going to be what's made in the crowd sale. However, there's no cap on that. It's decided by the rate, though, as well. I also mentioned the fund tokens, which are investing on the projects on top. So in the initial creation period, if any money funded above 500,000 Ether, so about $5 million, 50% of it's going to go to the fund, 50% of it's going to go to the platform. And then the platform's actually going to own the fund tokens, so it's indirect ownership for the crowd sale participants. There's a fixed supply, or actually a deflationary supply of the platform tokens. However, for the fund tokens, people could use a Futarchy mechanism to say, let's issue more tokens, effectively raising capital. And they could specify the rate they want to sell it for and the number of tokens that they want to sell.
You said at the very beginning that you started Augur, or started with Augur?
Mm-hmm. I was the founder of Augur.
So what made you leave that project? I mean, that project is still going on, isn't it?
Yeah, and I have not been there for a very long time.
Okay.
So first of all, it's a complicated question. So for details, ask me in private. But in general, there were disagreements, some nasty steps taken. I don't want to say more publicly.
Fair enough. So is that, I know you did have a slide in comparison with other crypto, so are you referring to primarily Augur? Are there any others?
There's Augur, there's Hivemind. I think there's some slightly decentralized betting applications on various cryptocurrencies, but mostly Augur and Hivemind.
Would you mind saying where you're based out of? I'm just really curious.
I'm currently traveling indefinitely.
No, the company.
Oh, so we're going to locate in Berlin. Both the co-founders are from there, and we're migrating there over the next 6 months. Also gives us an advantage of cost of living and hiring developers. Bay Area base salary is 140K, and that's not super great for early stage startups, and we can hire people for 60 to 70 there. Sorry, the rating system? I'm sorry, I heard the first part. Oh, sure. So I'll go in reverse. Reward system is the Oracle set their own fee. Obviously, they want to set it low so that they actually get customers, but it could be just a flat fee for resolving the market, or potentially it could be a fee as a percentage of the market. As far as the reputation goes, initially people will probably bootstrap this with social media, so sort of similar to Cloud, where we take a combination of Twitter followers, Facebook, etc. That's not really a good solution long term, so it'll be built up in the platform based on if you've resolved markets without dispute, how many markets you've resolved, and maybe there will be the potential for, if you're like Bloomberg, you could verify that you're actually Bloomberg.
Prediction market.
Yeah, are you Bloomberg?
I was just curious about kind of a more philosophical question.
Yes.
So, there's a lot of talk about the wisdom of crowds and stuff like that, but there's some cases where the crowds are kind of wrong.
Yep.
There's some cases where Steve Jobs refusing to pay a dividend, or Jeff Bezos refusing to pay a dividend, even though all the guys on Wall Street are telling him to do and stuff like that. And so it may be good in the long run, but in the short term, the crowd might turn out to be wrong about certain things.
Yep.
So just in general, can you talk about what people in your company have thought about these kinds of situations?
Sure. So kind of like two answers to that. The first is a lot of people have said, well, the chances of Brexit were like 2% in this prediction market, and obviously Brexit happened. So a general answer to that is, well, there was a 2% chance of it happening, but the real judge is over 50 markets. How accurate was it? The other thing to say is saying wisdom of the crowd is a little bit inaccurate. The reason being, in prediction markets, it's really the super forecasters, like people with complex models or just a really unique insight into that market that provide the new information to the market. And the crowd is trading lots in the market and providing liquidity for those super forecasters to come in and give the accurate information.
On the topic of sort of making a market anything, right? A question that I don't understand the technical ordinances for is do all oracles potentially resolve all markets? So oracles seem like kind of an obvious weak point in this system, right? Maybe it's hard to manipulate a certain market or costly to manipulate a certain market, but it's very easy to sort of manipulate the oracles or set up fake oracles that will always result in an outcome in your favor. How do you approach that?
Yeah, I mean, just in general, that's the security stuff I covered. So reputation, security deposits, sort of multi-sig of oracles, and then all of this, all of these security deposits are at risk for this last step decentralized oracle.
So I guess again, like even if it's a multi-sig, right, what's to stop me from setting up
colluding
multiple fake oracles of which I can guarantee that N of M are going to vote for my desired outcome?
Well, the market creator could decide which oracles. So
if I create the market and the oracles, what prevents that?
Yeah, good. So then someone would challenge it. It would go to the decentralized oracle mechanism, and you would lose all of your money that you risked on all of this. Unless you could outspend.
So that was actually a related question. When you sort of fall back to this prediction market oracle, how do you promote the fact that this market is now open? Like maybe there's one disgruntled person who's going to lose a lot of money in this market that I manipulated, and they're challenging it, and it goes to this oracle, but I can outspend them and just, again, the thing in my favor for 2 days. So like if they want to have kind of other people kind of pile onto their side and say, here's this dishonest person who's trying to manipulate this market, which is obviously, the other person won the presidential election. How do they make that public enough that they could get enough bandwagon to sort of offset my potentially large amount of money that all I need to do is outspend them for 2 days, and then I win whatever I was going to win in the initial market?
Good question. As for advertising it, the biggest thing is just that it's a profit opportunity and people will flock to it, so it'll self-advertise. Also we'll push it through social media and Reddit and all of our Ethereum friends.
What countries do you see as being the first early adopters?
Sorry, who?
Yeah, what countries do you see?
China. I mean, the two things in demand in China that relate to this are betting and financial shadow markets. I would expect betting to be a lower hanging fruit than shadow markets, but both are massive, massive markets.
Can you define shadow markets just for people there?
Yeah, so first of all, I'm not the best person to answer this because I'm not really a finance person, but it's just generally markets that exist outside of the normal regulated markets. So maybe I'm a trader in China and I have limited access to trading Apple, or I want super high interest rate deposits or whatever. I go outside of the normal banking institutions and participate in those. So in our case, it could be mirror assets for those things that people are trying to trade.
Again, sort of related, how do you prevent people from creating kind of a difficult to resolve market, sort of assuming that all oracles are honest? For example, the Brexit thing, if you use kind of currency as the outcome, currency level versus the dollar, that's sort of an easier thing to measure, and you're probably not going to necessarily have a problem with that. But say you pick GDP as the target, and say if it falls below a certain threshold, here's the payout. So the initial figures come out, and then a month later they're restated because that just sometimes happens. And then
Oh, sure.
in this kind of situation where it's like, are people going to be appealing to you to say,
Yeah, no, so
reverse the payouts on this?
yeah, no, so in the case you mentioned, it's just a matter of very specifically saying what the data point is. So, you know, it's whatever the Wall Street Journal says the GDP is on this date. So then you have, you know, well-defined terms.
And I guess the assumption is that if the terminology as I specified it in the market is fuzzy, you're relying on the judgment of bettors to essentially not participate.
Yep.
And then
And
they do,
yep.
and there's this sort of fracas over the resolution of it. What happens? Like they just sort of lose money on whatever the initial batch protocol said, or then have to appeal, or
Yeah, it would have to be continuously appealed. Yeah.
So in order for this to be truly decentralized, did you think it was absolutely necessary to conflate like Futarchy and the DAO to govern your corporation and everything, along with creating the best decentralized prediction market? Or could you just said, okay, the protocol and the smart contracts and the blockchain will run this thing decentralized. We have a for-profit company that's building clients and services on
Right.
top.
Right. So yeah, I mean, there is this challenge of like platform versus for-profit company. And our thinking there is that it's more transparent and fair to the crowdfunding participants to know that they're going to get at least a portion of some of these for-profit companies. So, you know, maybe someone goes off and creates some application that's going to be built on top. Well, the Gnosis fund could actually invest in that, then providing a revenue stream to the crowdfunders. Is there other parts of your question that I didn't get at?
I mean, basically, you thought it was just more fair to the
Fair and transparent. Yep.
Are they? But is it necessary to conflate that with the market itself, or could you just independently have decided, oh, we want to run a crowdfund to distribute a crowdfunding effort to distribute equity in our corporation?
I think that specific example would face difficult regulatory burdens.
So instead, the tokens you receive as part of the crowdfund have a use in the platform.
In the actual software.
Related to fees again, something I just thought of. So, would your prediction market be more expensive than one that didn't charge fees on top of just how much it costs to execute a contract? Like, could you?
Okay, so are you talking about like a parasite contract that copies our code and runs the same code and?
Maybe not necessarily your code, but like a competing prediction market that doesn't charge platform fees.
Mm-hmm. Yeah, so.
It's just a smart contract and people can interact with it.
Right.
But it doesn't collect separate fees.
Got it, yeah. So one thing is over time we want our fees to trend as low as possible, partially because of problems related to that and to remain competitive. The other big thing is, okay, maybe that thing has no fees, but it has very poor liquidity and thus very poor odds. So users would still prefer our platform because they're getting a better deal on the odds.
I'll ask you something else now, I promise. Have you considered, or anybody who wants to build on top of Gnosis, talking about kind of creating almost standardized markets, if you will? I think there's been some theoretical research on kind of prediction markets, and they can add more value if, you know, sort of under certain conditions of, you know, relative sizes of bets versus wealth and things like this. The same traders sort of survive in the market for a lengthy period of time, kind of betting on the same event repeatedly, and this will sort of converge towards, you know, base reality in the long run. So it seems like, to the extent that that theory bears out in real markets, there would be value in having kind of more consistent markets. I haven't actually seen the interface for this. I've seen the interface for Augur, and it's like sort of one-off. I create a thing, and people participate right now in the way that I participate right now, and then it's gone once it expires. You know.
Yeah.
Have you thought about this, or do you have the capability to allow this to be built?
Yeah, so two things. I mean, first of all, like when I plan like test markets to make, one category I do is like recurring markets. So like what's the price of Bitcoin going to be every month, and just keep creating it. More generally, I think a lot of that's going to be pushed to the application level. If you're doing something specific, you'll probably want to create recurring markets.
So there will be a tool where different market, different user nodes will be able to see the result of different prediction methods across different categories.
Yeah. Yeah, statistics and graphical views will be built. There's already like some basic stuff for that. It just shows the share price for various shares over time as a graph. But yeah, it's going to be important to implement better visualizations for that.
And can you aggregate that kind of across markets if they're more than so the Bitcoin example that you're giving, this is kind of like a continuous market and people are making a bet on the future price of Bitcoin a month out from now. If they're doing this for 2 years, can you kind of aggregate the data across 24 contracts?
Yeah, I don't see why not. We haven't built it, but good feature. Jake?
Talk a little bit about the state of development.
Yeah, so Gnosis has been in development for about 1.5 years. The first mainnet version, for those who don't know, mainnet is the main Ethereum chain that has the real money value. It was live for about 6 months. We took it down a few weeks ago. We are next week releasing sort of the next mainnet version. You can create markets, you can create oracles, you can crowdfund initial subsidy for markets, you can trade in the markets. There's a JS library to do a little bit of market customization, but we don't really have the full tools to make it easy for users. That's most of it. Oh, also we've done like significant work on off-chain trading. I think Stefan actually did like the first real state channel implementation. So we did research on that, but now we're going to use Raiden for that. Nothing else? Cool. Well, thanks for listening.